Hello and welcome to an introduction to technical analysis, module 3, topic 3. In the previous topic, we spoke about defining the bull market. And in this topic, we're going to look at the bear market and how to correctly define when the bear market commences or begins. So let's get started. You will notice, and you'll remember from our previous topic, that it is the overall direction of that moving average that is all important. And that really defines the actual primary trend. So in the bull market, we spoke earlier, the rising 200-day moving average defines the bull market. But in a bear market, it is the falling or the negative sloping 200-day moving average which determines the bear market. We also mentioned that in the rising bull market with the 200-day moving average, that the 200-day moving average will act as the ultimate support of a market. Well, it's just the opposite in the bear market, meaning that in a bear market, the 200-day moving average will act as resistance. It is the ultimate resistance line for a bear market. So you'll notice in the chart that is currently on the slide that a 200-day moving average is sloping downwards. You can see that prices are struggling to get through that moving average, and every time it moves towards that moving average, it continues with its primary trend bearish market. And you'll see with the highlighted area that I've highlighted over here is that there are times where the prices will penetrate that moving average. But this is where the misinterpretation takes place, and in that area, people will often say that the 200-day moving average has broken back above its moving average. The prices have broken back above its moving average, therefore this constitutes a bull market. But you can clearly see that that was a great area for one to start looking to sell rather than getting involved in the market and buying this again. So just as Joseph Granville explained that there are 4 ways to interpret the 200-day moving average in a bull market, there are in turn 4 ways to interpret the 200-day moving average in a bear market. Firstly, the 200-day moving average flattens out or declines following an advance of prices, and the price of the instrument will penetrate that moving average from above. This will provide us with a good selling opportunity. The second way to interpret it is, of course, if the price of the instrument rises above the moving average while the average is still declining, just as our example in our previous chart, this also constitutes a good selling opportunity. Thirdly, if the price of the instrument is below the moving average but advances towards it without penetrating it, meaning that it gets stuck at that resistance level, this is also an opportunity to sell. And the last way to interpret this 200-day moving average in the bear market is, of course, if the price of the instrument rises too far, too quickly above the declining 200-day moving average, a short rebound, a short pullback towards that moving average will be a high probability, and therefore it is a good opportunity for you to sell the underlying instrument. This brings us to the end of Module 3 and the end of Introduction to Technical Analysis. We hope to see you in the future courses of Technical Analysis. Thank you.